Hello, hello, hello. Welcome to our stock trades. In this video, we're going to go ahead and talk about Clover Health with the sentimental analysis. And we're going to go ahead and drop some jewels in this video. I did set this video for the PM. I meant to do AM. My apologies. But regardless, I got some really juicy stuff. So we all know, well, some of us, that you want to stay away from the stock market when it is at its peak optimism. In fact, that's when you want to raise the most money. You want to use that to basically propel you forward, right? But most definitely, you do not want to invest during these times. At the same time, when the stock market is very pessimist in terms of people are scared of the stock market, you do not want to sell during these times because most likely you're going to be selling into a bad deal. Okay. Vice versa, you want to buy when the market's fearful and you want to sell when the market's greedy. So that's kind of the average concept of the whole Warren Buffett type of Benjamin Graham value-based investing analysis, right? So I just had some time with a couple of physicians during this week, and a lot of them were like scared of the market. Like, I don't want to buy right now. It is so red. It is so red. I want to buy when things are going up. And I just, these are one of the most smartest people in the world. I mean, being a physician in the United States is no small footing. You really have to be smart to be a doctor in this country. And I find it so interesting how someone can have lectures of biases and cognitive bias can exploit such cognitive dissonance. And I just find that so amazing in the study of the market. It's such a beautiful psychological experiment that the most biggest problem that folks have is not knowing what they hold because they don't, and it all stems from a lack of education. So in this video, back in 1949, Benjamin Graham created a social contract. And this, I'm going to show you here, is that specific social contract. So I'm going to read this to you, and I'm going to read this social contract. It says here, and I'm going to say my name, Albert Allen, hereby state that I am an investor. Now, I recommend screenshotting this and making your own social investor owner's contract, okay? I'm an investor who is seeking to accumulate wealth for many years into the future. Remember, this was like back in 1950s, okay? This is like, we're going to do a lot of education here, okay? I know that there will be many times when I will be tempted to invest in the stocks or bonds because they have gone or are going up in price. And other times when I will be tempted to sell my investments because they have gone or are going down. I hereby declare my refusal to let a herd of strangers make my financial decisions for me. I further make a solemn commitment to never to invest because the stock market has gone up and never to sell because it has gone down. Instead, I will invest blank amount per month, every month, through an automatic investment plan or dollar cost averaging program into following mutual funds or diversified portfolios. Boom, boom, boom. I will also invest additional amounts whenever I can afford to spare the cash and can afford to lose it in the short run. Okay. I hereby declare that I will hold each of these investments continually through at least the following date, which must be a minimum of 10 years after the date of this contract. Now, this is for the general investors, for our Mastering Stock Market students. When you do an intrinsic value calculation, you hold it to that price, all right? Or if the fundamentals change based off of the 3 months earnings call, you get the drift, and you can write the date here. The only expectations allowed under the terms of this contract are a sudden pressing need for cash, like a health care emergency or a loss of my job, or a planned expenditure like a housing down payment or a tuition bill. I am, by signing below, stating my intention not only to abide by the terms of this contract, but to reread this document whenever I am tempted to sell any of my investments. This contract is valid only when signed by at least one witness and must be kept in a safe place that is easily accessible for future reference. I made my own contract, God, over 10 years ago. Okay. So take a screenshot. And if you're on our Discord, in the exclusive daily briefing with all of our softwares, I put it in there so you could just download it from there. Okay. Remember, the stock market, it's a mentality. Individuals that don't know what they hold, like for example, Clover would be like the stock is going down. Obviously, there's no more value. So I'm going to go ahead and I'm going to sell. That's the ideology. That's the thinking of, unfortunately, many people invested within the stock market. Likewise, I saw someone said AMC is dead. Well, here's the thing about AMC, just a quick little splurt. If you look at my videos about 5-6 months ago, I said fundamental analysis, fundamentally, AMC stock price is way overvalued from its current fundamentals. But many people said, well, this is not a fundamentals play. In the long run, it is always a fundamentals play. But in the short run, in terms of shorts covering, that could be a potential squeeze. But imagine when the whole market is bleeding, what ends up happening? All stocks fall. But unfortunately, many of the retail community investors have cracked, like, for example, Trades, right? Leaving and not wanting to talk about AMC. Imagine how many people just followed him blindly. So unfortunately, the ingredients of a short squeeze requires, obviously, shorters, people that short the stock, but it requires continuous enforcement of holding the security in question until the other entity covers. The problem is that's crumbling. So maybe you are right. Maybe that may have been, maybe AMC may be dead. We could do an intrinsic value calculation on it, but my recommendation is watching my old video where we calculate the intrinsic value of the stock, and it's falling right in line to the fundamentals. But this is excluding the ape dilution that they just did. Okay, now from this, I'm going to show you a couple of quotes, and I'm going to give you guys some data. So price here, let's go ahead and let's show us here. So price is what you pay. Value is what you get. Okay. Price is what you pay and the value of it is what you get. So individuals that have purchased this Clover Health stock at the $5, $10 region, what has changed in the company? Well, the revenues are more. They're getting closer to free cash flow and net income positivity. That is their plan for 2023 and 2024. The company has essentially went into other states, and they've increased in star ratings since that stock price, right? And management hasn't, brought a new CFO. So the price is what you pay and the value is what you get. Now, personally, in my argument, based off of this, this particular price action, I'm getting more value based off of the price I pay. But unfortunately, if you talk to a lot of retail investors, they're saying no. In fact, I had one person comment saying your intrinsic value calculation is flawed. It's not working for Clover, right? It's just, that's the mentality of people. It's just, people like to follow the herd. They like to follow. There are going to be followers and leaders. And if you say, it's easy to say, I'm going to be greedy when others are I'm going to be fearful when others are greedy, and I'm going to be greedy when others are fearful. It is very hard to do that. That is a very hard thing to do. And if you're not practicing this now, the real investors of our time is doing it now. Now, if the fundamentals change, the revenue starts slipping and we're getting 5-10% revenue and they're nowhere near free cash flow, then the story has changed, right? But overall, Adobe's down 50%. CrowdStrike is down. I mean, there's so many great stocks out there right now that we're going to go ahead and go through them one at a time for the defensive and aggressive investor. That value is what you get based off of the price that you pay. But a lot of retail investors like to overpay. Now, beware the investment activity that produces applause, and the great moves are usually greeted by yawns. So us now saying, you know what, we're going to go ahead and average down when it comes to the stocks. We're going to go ahead and average down on Clover. No one really seems that excited. In fact, if you go to the Reddit page now and you look at the Reddit, how many negatives are you seeing? You just see a slew of people just spewing out negativity. And it's amazing how the psychology of the market works. That is the time. Obviously, you have to do your due diligence, you can't just invest in any stock that people talk bad about. When you compare it with its fundamentals, that is the perfect time to execute your rifle and to attack the stock at hand, which is part of all underlying business. Warren Buffett says, I will tell you how to become rich. Close the doors, be fearful when others are greedy, and be greedy when others are fearful. Right now, we're in the market where we need to be greedy. Being greedy now will help in the future, right? You want to buy when everyone's selling and you want to sell when everyone's buying. That's pretty much how it works. Be prepared to invest in a down market and to get out in a soaring market. There you go. Next quote. The stock market is filled with individuals who know the price of everything but the value of nothing. Many individuals can come here and say, well, Clover is sitting at $1.80. Well, okay, that's what it's trading at. But what is the value of the company? But they don't know that. They don't know what an annual 10K report is. They don't know any of this. That's why the most important thing you can do, actually, the last quote, an investment in knowledge pays the best interest. Because if you're knowledgeable, you'll be able to navigate anything that you can come across through life because you'll be able to break it down to its first fundamental principles of thinking, right? You'll be able to break it down and build it back up, right? The 4 most dangerous words in investing are, it's different this time. Did you hear that in the past 2 years? It's different this time. Crypto it's different. NFTs, virtual properties. Are you serious? It's different, man. You don't know what you're talking about. Fear, uncertainty, and doubt. FUD on your mama, FUD on your father, FUD on everything, and FUD on your grave. That's literally what people were like. But where are those people now? Okay. My favorite one by Peter Lynch. You get recessions. That's what you get them. Okay. You have stock market declines. If you don't understand that's going, that it's essentially it's going to happen, then you're not ready. You won't do well in the markets. Okay. So now let's go ahead and let's take it with our smart money, dumb money graph, which I explained many times, but I'm going to keep explaining it for all those new people. Whenever you sign up for a brokerage account, you tell them how much money you have, and they are able to track your trades and essentially sell that information. Smart money is obviously the hedge funds, and dumb money are retail investors. Let's go ahead. Back in the end of 2018 and entering 2019, stocks dipped. Dumb money sold. Smart money bought. Great investment. And then as stocks went up, smart money cooled off while dumb money essentially bought at the peak. Same thing happened here. The 2020 pandemic. Stocks fell. Dumb money and reds basically sold while smart money continued buying. As stocks essentially started to recover, dumb money started buying, and they continued to buy until now we're basically falling again. Dumb money is basically selling while smart money is oscillating every time buying the dips when the dips happen. Okay? Ladies and gentlemen, this is our little logo here to help us. In the past 10 years, how many peaks do we have? We got a peak here in the end of 2019, when the whole China trade ban and all this was going on with Donald Trump. You can see here that this was a perfect time to get in. What was dumb money doing? Dumb money was selling. This is the equity hedging index, looking directly at the hedgers. Looking here at the bottom, in terms of hedge funds, right? Looking at the bottom here with a dip. We had a great spike. You want to buy in spikes. You want to buy when it's above this 80 threshold. Well, guess where we're at now? We're at that threshold. See how beautiful this is? And this is a very slow, clean indicator. See how slow this is? See how clean this is? This is a very clean indicator. Okay? So, ladies and gentlemen, it is easy for people to invest, but it is hard for people to make money. Okay? Many people that started speculating, not investing, speculating in the market in 2020 thought that they were some god, thought that they were good at it. Their inner biases came out saying that I have a special niche in the market. I am a genius. When in reality, They did not do any due diligence. They did not study and they did not analyze the market. Some did, and some profited on this and realized the pattern that they were in of peak optimism. And unfortunately, some did not. So, right now, we're at a market where we are near pessimism. In fact, if we go here and look at our analysis here for the fear and greed index, which unfortunately can be manipulated by hedge funds, fear and greed index, we're going to go ahead and see. So whenever you have above 30, we are in fear. So let's go ahead and let's zoom in on here. Yep, we are above 30. So we are definitely in fear. Let me go ahead and do this. So whenever you are at over 30, which is above this line, you could draw a line here. These are great times to buy. Okay, you want to buy when others are fearful. That's the greatest time in the market, right? Again, on the SPY says sell on the fear and greed. NASDAQ, sell, sell. So I want to ask you a question. Based on this, where are we now? I believe finally retail is going to start capitulating. And we are seeing that now. Retail investors are just getting out of the market. They're watching all their money go down. And they're going and entering despair. And we're slowly oscillating back to the mean of the company, right? Or whatever, of the whole, essentially, S&P. And we can see that average to the historic mean in our core valuation models here that we can see. We can see that we're slowly starting to come down back to the historical mean. In fact, if you go to the S&P mean reversion, we're slowly reverting down. Let me just go ahead and zoom in here for you. Okay. You can see how we're slowly going down to this historical trend line. We were at 2 standard deviations away from the mean. And last time we were 2 standard deviations was in the .com bubble crash. Many people saying it's different, it's different, it's different. Well, where are we now? It wasn't different, right? And I hope that this will educate you. And some maybe will curse me out. This is how it works in life. But some will learn from this and be able to change the wealth of their whole family and the generations to come. You could see here during the 2020 pandemic, we hit the historical trend line. We may even go and hit it again, or might go halfway. We don't know. But all we do know is that we are in the bottom, or next to the bottom of the market. In fact, what I want to do is I want to show you a couple of things that are very interesting to me, at least. Let me go ahead and flip the camera over, and let me show you a graph that I find particularly very, very interesting and amusing, to say the least. Give me one moment. I promise you it'll be worth your while here. I was going to show this later, but I think it's good now. One moment, please. Okay. And as I'm doing this, I'm going to read the comments here. So I'm glad that you're going to print one out. That's good. Yeah, covered calls definitely would be, they're definitely a great idea to turn a growth stock into a dividend stock, but I wouldn't say right now is the market where you get these insane run-ups. Maybe possibly during earnings, I would be careful. In fact, you can make a killing with that too, but that's when the covering of calls is really significant. But as the stock goes up, don't get too greedy on that, because you may just sell out early or prematurely sell, and then unfortunately you'll miss up on a greater return, right? I mean, that is the risk, but overall it seems to be very in a very controlled manner. So as I'm going to basically pull this graph up here for you guys, I want to show you something quite interesting that will definitely help you with your analysis. So do you guys know technical analysis? Are you aware of the technicals? Yes or no? So within that question, there's a sub question. Do you guys know the 200-day moving average? You guys know that about the 200-day moving average? So there's something called a 200-day moving average, and we spoke about it in a couple videos before. And I said, be careful, folks. Do not get confused with a bear market rally. Always have cash on the sides, right? So we're going to go ahead and we're going to show you this graph that we have, okay? So this is from a very famous book. And again, it's going to be part of our Mastering Stock Market course. We're going to basically show you fundamentals and technicals and bleed them together to help you. But essentially, what you want to do is when you go into stage analysis here, we're currently in stage 4. We got a fake out where the line touched the 200-day. Again, this was back in the day. For the 30-week MA, think of it as a 200-day moving average. So think of that, okay? So this is essentially the stock market, how it hovers, and the 30-day or the 30-week MA, or I'm just going to call it the 200-day moving average, is this solid line, not the one that bounces up. That's the stock price. What you can see here is during a bear market rally, stocks try to touch the 200 moving day, okay? What you want to do, the question is, okay, well, don't essentially put all your eggs on one basket on a company that's just basically touching its 200-day moving average. The next question that you might ask yourself is, well, when is a great time? Well, another great time to basically get in is not here, but here, when the 200-day MA is supported. See how there's one bounce off of the two, again, it says 30-week, but it's 200-day. We have the first bounce here. We have the second bounce here. Great entrance from a technical analysis perspective, okay? But remember, technicals by themselves don't really do you much if you don't know the intrinsic value of a company by calculating its DCF and then going 10 years into the future, dividing by the number of outstanding shares using a 2 to 3% perpetuity model with a 10 to 15% discount rate on top of a 20% margin of safety, okay? So there's that. You might have to replay that. Whoop. So where are we now? Well, here's a nice graph that looks at the 200-day simple moving average. It's named differently, but it does do the point. The 200-day is the solid red line, and the stock price, the S&P 500, is the blue line. Now, just for a second, ignore the green line for just 1 second. Just focus on the blue and the red. Blue and the red. I just want you to focus on this line and that line, okay? Now, what you can do here is during the dip, we started this immense rally, and the 200-day was touched. But unfortunately, it did not cross, and it got rejected. And now we're going back down. So we are most likely going to, whenever we'll see another bounce. The goal that you want to do and the goal you want to be on is essentially here, okay? What this tells you from a technical analysis perspective is you don't want to essentially buy here. You want to buy, this is the first bounce, and this is the second bounce. Then you want to get on here. And then from here all the way up to essentially here, you see how it bounces, the stock price bounces on the 200-day MA. At that point, then you ride all that up, which is a pretty significant rise. But me being very greedy when others are fearful, I like to do intrinsic value calculations and find the value of the company. And I know that whatever economic, war, or any type of factor will relieve itself, we will then ultimately cross this, and then you'll get this bounce and then a double bounce, right? And then you can, when the intrinsic value of a company is met, when you satisfy that and when you get to the price target, you can then essentially watch this, sell the original investment or do a stop loss that goes up, or just do a little trick on Thinkorswim or something where you can program a sell or alert you when the 200-day moving average slips. And once you get that slip and breakage, and in fact, they call it a death cross, right? But essentially, when you get that breakage, this will be a great time to get essentially get out, right? So I hope this was very helpful. Okay, this was very helpful to kind of give you guys some little juice and some gems here. Okay, now let's go ahead and take a look at the questions here really quickly. I'm not going through them really fast here. No, amazing. It's good. It's a pleasure. Yeah, possibly because one of our members on our private stock group said that the stock twits Clover started trending, which is pretty good. Mm. Absolutely, but the thing is, you have to remember the stock market's very prognostic around about 9 to 12 months of the future. So it tends to look at future problems and tries to wrap it within the stock price now. It's honestly, and sometimes it may get the future wrong. So I wouldn't be surprised if, let's say, the market recalculates its calculation once the Ukraine war is over. Then I would say the market's definitely going to see some beauty. But yeah, when will they start reducing their net loss? Take a look at my last video, or just go directly to the source from Andrew Torrey. He talks about it in his LinkedIn page in regards to net profitability by 2023 and 2024. So take a look at that. But anywho, folks, that's all I have for you today. There was a lot, and for people that just basically joined, I feel like I would be doing you disservice if I didn't repeat this. Here's a contract that Warren Buffett's mentor essentially made him do, and you can put your name and you can essentially make a contract with yourself, because unfortunately, when the stock market starts to fall, people are tempted to sell, and when the stock market rises, unfortunately, people are tempted to buy, right? So in the future, when we do enter the next bull market, a lot of you folks are gonna be like, Al, Clover's gone up, it's amazing, what's the next pick? And I'm gonna say, well, I haven't found it yet, right? I'm gonna give me some time, right? You get what I'm trying to say here? It's in fact, just a kind of little side note here. I'm working on a little project. I'm actually going to be thinking about opening up a Pinkberry somewhere in the state of Arizona. Yes, yogurt place. I'm still looking at the intrinsic value calculation, but I do see some great gross margin returns on yogurt. The reason why is, the hospital setting can be so gruesome that I think selling some nice yogurt, I don't have to work on the brand or anything. I could just Pinkberry, and giving people hope with ice cream and seeing them smile with the Pinkberry. It's a lot different than what we see in the operating, not in the also neuro ICU. So I think it's nice to give smiles on people's faces. So that's something that I was looking at the other day. So I think I may do that. There's a couple of things that I found that is a gap in when people travel in the United States next to Tesla superchargers, and I think that's a great business to implement those things. Okay, so so when the market does go up, expect that our price targets are going to start shrinking in terms of the intrinsic value. It's going to be harder to find a deal. It still quite is in the larger caps. Again, Apple finally started falling. To all of our members, we did talk about Apple and how it was overvalued about 6-7 months ago when it was trading over the 160s and 70s. Same thing with Microsoft. In fact, just to make sure we, because sometimes folks don't check our long-term price targets. We are going to be updating this to make it into a nice little form. Back on September 21st, I said that our radio frequency device company just hit our price target of $95. There was a great 50% return, and you could have double dipped that return if you would have essentially, just rode the intrinsic value price. But back on back on January 14, we set a price target on PI, which is a radio frequency identification software. So for people that are wondering, is it hard to make money during this market? Absolutely not. It's always easy to make money. And it's not easy. You got to do your due diligence, but there's always opportunities. So on September 21st, we essentially set out a sell rating on this company on the 21st, so we can look at a month. So literally right before it dipped on the 21st, when the stock hit our price target, we told our members to essentially, this is it. It's starting to sell. And congratulations to all you guys that have sold at this September 21st, because now it's down 13%. But if you looked at it, definitely a great run that we had. A great run. Over, essentially doubled your money, but we called it out a little later. So I think it was 50% instead of the 116%. Same thing with On Semiconductor that hit our price target, so a couple of other stocks. So make sure you check this. Make sure you check. There's always opportunity in the market. We are going to be updating this. It's just it takes some time. It just takes time. If it was easy, if it was easy, everyone would be doing this. You know what I mean? It's just this takes time, and a lot of our members are essentially learning how to do this, and we're not even done yet building this platform. We are like far from it. I'm literally, Rome wasn't built in one day, and it's come to be a very true statement with what we're trying to accomplish here. Okay. Let's go ahead and so I would take a look at their revenue, their free cash flow, and everything, and I would take a look at it. But based off of metrics, we can make a video for that. But last time I checked, I wasn't surprised. I wasn't amazed, but I can definitely check again for sure. Okay. So, anywho, that's all I have for you guys. Hopefully, this was a good mental video to help you with your emotions. I will see you soon, and don't forget to check out our links down below on how to think like an intelligent investor. And that's all I have for you guys. I'll see you in the next one.